Hello traders, you're welcome to this video and I especially welcome you back to the Forex Geek channel. In this video, we're just going to be diving deep into something that is going to level up your breakout trading strategy, and that is how to trade breakout setups using the relative measured volatility indicator. So I'm just going to be adding the relative measured volatility indicator to the chart right now. All right, so it's the RMV for short. Now, this is one of the most underutilized tools in trading, and after this video you'll know exactly how to use it to avoid fake outs and catch the real moves. Okay, so first off, what is the RMV indicator? Well, the RMV stands for Relative Measured Volatility. Unlike general volatility indicators that just tell you how much price is moving, the RMV tells you how the current volatility compares to its historical behavior relative to the context of the market. In other words, it shows you whether the market is building pressure or ready to explode. Okay, now if you have been trading for a while, you know breakouts are a double-edged sword. They can lead to big moves, but they also trap a lot of traders with fake outs. Okay, so the goal here is to use the RMV to filter out the noise and spot setups where volatility expansion is just beginning. So here is how to set it up. Once you load the RMV indicator on your chart, you want to look for periods of low volatility compressions. All right, look for periods of low volatility compressions where the RMV value is low and flat. All right, you want to look for periods where the RMV value is low and flat. All right, so that's your first clue. These phases are usually when price consolidates. You can see that when the RMV values are low and flat, we have, a period of consolidation, right? Like what we can see happening around here. Okay, there are phases where usually, when price consolidates near a key level, and as you can see that we have a key resistance zone around here. All right, it could be a resistance or a support zone. Think of it like a spring being compressed. The longer it builds up pressure, the stronger the breakout. All right, now the next thing for you to watch for is the RMV spike. You watch for the RMV to spike. To be specific, you should watch out for, the rally of this particular blue, move. When you are looking for a period of consolidation, you watch out for, a phase where you have those white lines, around these low levels. And then when you have the blue line emerge, just pay attention for something significant coming up soon. So in this case, we can see that we actually had there was actually a strong bearish candle, and then shortly afterward we had a breakout that led to a little decline. Okay, we didn't have a significant decline at the time. Yes, the decline was just short, but then there was a brief consolidation again, and look at another blue line appeared, and at this point we had a notable breakout. You can see that the breakout climbed all the way up to this place, and then you can see that here again we had a pullback, and then we had the emergence of the blue lines. Okay, then there was another breakout to the upside again. Okay, so basically when you are using this indicator, the things you should be paying attention to are the white lines, or rather this spacing, right? When you have this spacing with the white lines low, showing a period of low volatility, and then watching out for the blue lines emerging, showing that a significant move is probably about to happen. Okay, so when you are noting that the blue line is coming up and you see price being rejected around the key level, be it a support or a resistance, you should be paying close attention to a possible breakout or a possible reversal. All right. So for entries, you can go aggressive and enter on the breakout candle close. Okay, in this particular scenario, we can see that this breakout actually continued. If we are going to be, very practical, this breakout actually continued to this point. This was more like a false breakout here, because after this breakout happened, the price suddenly reversed back to the upside. Okay, and that shows that no indicator is perfect. No indicator guarantees profit. All right, because even if you had entered a sell around here, if you hadn't exited quickly, you would have gotten stopped out, because price got rejected around this support, right? Then we had a breakout to the upside, and then we even had a retest at this point, and then you can see that price is now continuing back to the upside after this decline. Okay, all right, so now when you have a legit breakout that has been verified, ensure that the candle closes. If it's a breakout to the upside, ensure that the candle closes above the key level, above the resistance. Then after the candle has closed above the resistance, you wait for a retest. It could be a brief retest like what we had here. And then once you have verified that retest, all right, wait for a bullish candlestick pattern for a continuation. Then you can enter a buy. Stop loss can be below the breakout zone, the breakout and retest zone. Then your take profit can actually be around key resistance zone. All right, that is for your take profit can be around key resistance zone, and ensure that you have a good risk to reward ratio. Okay, it is very important to have a good risk to reward ratio. All right, so that is it for a long trade. And if it is a case where you have a short, a breakout to the downside, all right, you also watch out for it could be a bearish or bullish breakout from a trend line. It could be a bearish or bullish breakout from a horizontal level. Either ways, a breakout is a breakout, right? So if it's a situation where you have a breakout, to the downside, also watch for a retest. You can see we had a retest here. After your retest has been verified, this one was the case of a, breakout from a trend line support. So we had a retest and a continuation pattern. So once you have confirmed that continuation, your sell can be entered. Stop loss above the breakout and retest zone. Take profit around key levels. Just ensure that you have a good risk to reward ratio. You can take your profit around, support zones, key support zones. Okay, so this strategy works across multiple time frames, whether you are scalping 5-minute charts or swing trading 4-hour setups. The RMV adapts. Okay, and if you combine it with trend filters like moving averages or higher time frame structure, your win rate can go up even more. So that is a quick but powerful breakdown of how to trade breakout setups using the relative measured volatility indicator. It's not about chasing moves, yeah? It's not just about that. It's about understanding the why behind the move and being early, not late. So if you found this helpful, smash the like button and make sure to subscribe to the channel so you never miss a strategy breakdown that actually works. Have you got any questions? Drop them in the comments so that I would hear your thoughts. Thank you for watching, and until next time, stay sharp, stay disciplined, and let volatility be your edge.